If you are someone who lacks the time, the interest, or the skills to actively manage your investments but still want good returns, mutual funds are for you. I can't stress this point enough. They are the only investments that you need. But then, most people are confused or clueless when it comes to mutual funds. I've been investing in mutual funds for some time now, but still, forget selecting a fund by myself. I couldn't even check if the fund recommended to me was suited for my financial goals. When it comes to our investments, we blindly trust the word of others. This is our hard-earned money, so we should know where it is invested and how it is being invested. So I started researching on the internet, reading every book that I could find about mutual fund investments, made notes, and finally summarized all that knowledge into a series of 5 videos. Once you watch these videos, you will have a good understanding of the basics of mutual funds and will be in a position to choose the best fund for you without the help of anyone else. Understanding this is a one-time effort. Once you get it, the knowledge will stay with you forever. So let's get started. If you are new here, my name is Srijit, and on this channel, we talk all about wealth and happiness, and sometimes mutual funds. Now, I am not a financial advisor. I'm just a random guy on the internet sharing my experiences. So please do your research before you act on any of the things I say here. So, what are mutual funds? It is simply a way to pool the money from a large number of small investors and then give it to experts to mutually buy stocks, bonds, and other investments. A company collects the money and fund managers invest it in on your behalf. But it's not just the company and the investors involved in a mutual fund scheme. A mutual fund consists of mainly 5 stakeholders: a sponsor, asset management company, trustee, transfer agent, and custodian. We will look into each one of it in detail. The role of the sponsor is to set up a mutual fund business with the intention of making profits. For example, Vanguard is the sponsor of Vanguard Mutual Funds. The responsibility of the sponsor includes setting up a company to manage funds called XYZ Asset Management Company and appointing a group of trustees. Asset management companies, or AMCs, are financial institutions responsible for managing the day-to-day operations of mutual funds. They are also called fund houses. It's normally a team comprising of the chief investment officer, the fund manager, and analyst who oversees the fund. And for the service, the AMCs charge a fund management fee as a percentage of net assets managed. But what if the sponsors and the AMCs steal our money and vanish? They can't, simply because they don't have direct possession of our funds. The investor money is held by a trustee company or a board of trustees. Mutual funds are always set in the form of a trust. Trustees are the people within a mutual fund organization who are responsible for the safekeeping of investor funds and ensuring that the interest of the investor is protected. The rules and laws related to trusts are normally very strict, and if found guilty of fraud or misuse of funds, the trustees can lose their personal assets and be jailed. We learned earlier that mutual funds invest in securities such as stocks, bonds, and others. And as the name indicates, the role of a custodian is to safekeep all the securities bought by the AMC. A registrar and transfer agent, or RTA, has the responsibility of maintaining accurate and up-to-date records of mutual fund investors and their investments. They keep track of all transactions and give investors a single window reference for all the mutual fund investment related information. So in short, the sponsor set up the business, the trustee holds the investor's money, the AMC creates and maintains the mutual funds and invests in stocks, bonds, gold, or any other securities, and these transactions are then recorded by the RTA. Now there is one more party involved, and it is responsible for safeguarding the interest of the investor. They regulate the industry by making guidelines for everything from setting up a mutual fund, launching a scheme, creating and managing the portfolio, investor protection, investor services, and so on. In the US, this is the US Securities and Exchange Commission, or SEC, and in India, this is Securities and the Exchange Board of India, in short SEBI. There are also mutual fund associations formed by mutual fund companies, and they represent the interest of the industry and recommend best practices to be followed by the industry members. The Association of Mutual Funds in India, or AMFI, is such a body. Now let's get to know some key terms when it comes to mutual funds. These terms will be used a lot when we get to the phase of selecting the funds. Net asset value, or NAV, is a price per unit of a mutual fund scheme. We know that a mutual fund consists of a group of securities such as stocks and bonds in some proportion. If we take the total value of all the securities in the fund portfolio, subtract any associated costs, and divide it by the total number of units of the mutual fund. We get the NAV. Or in simple terms, the money you need to buy 1 unit of the mutual fund, or the money you get when you sell 1 unit of the mutual fund. NAV is normally calculated at the end of every market day after taking into account the closing market prices of stocks and other securities in the portfolio. NFO or new fund offering is a price per unit or NAV of a mutual fund when it is newly launched. NFO allows the investor to buy the mutual fund at a low rate. But keep in mind that a low NAV doesn't necessarily mean a good mutual fund. Now, 2 other key terms to understand in connection to mutual funds are equity and debt. Most cases, the money you invest in a mutual fund ends up in one of these 2. Equity is fundamentally about the ownership and the value of ownership. When you buy a stock of a company, you are ideally buying a percentage of ownership in that company. For example, if a company had 10,000 shares and you owned 1,000 of them, you could say that you held a 10% equity stake in that company. In short, if you buy stocks, you are buying equities. When we hear the word debt, it makes us think of car loans, home loans, and credit card loans. But in the world of investing, debt is just an umbrella term for all financial products that are based on borrowing. These are the products that give you a guaranteed return after a fixed period, like a bank fixed deposit or a government bond. Now, if you're not familiar with stocks, bonds, and basics of stock market investing, I highly recommend watching this video where I've explained it in detail. We will learn more about equities and debts in future videos. But for now, just understand that the purpose of investing in equities is to grow your portfolio, and in debt is to give liquidity and safety to your portfolio. There are 2 ways to invest your money. You can either put a lump sum all at once or make regular periodic investments. The second method is called SIP, and it has its benefits. Most of us have a regular flow of income in the form of salary. A SIP helps to convert that income into regular investments without having to figure out what to do with it every month. It brings much needed discipline and makes investing a habit. And also with the SIP, you will invest regularly without worrying about how the market is performing each day. So it also takes the emotional factor out of investing and results in steady capital appreciation. But suppose you came into possession of a large sum of money. Let's say you won the lottery. It could be that when that happens, it's not a good time to invest in the stock market. Then the best option would be to park the money in a low-risk debt fund and then transfer it at periodic intervals into an equity scheme. This is called a systematic transfer plan. Similarly, there also exists a systematic withdrawal plan or SWP to regularly withdraw your funds and exit the mutual fund investment. SWP is a mirror image of SIP and is a good option for investors who need a regular income to meet their monthly expenses, for example, after retirement. If you opt for an SWP, the AMC will sell units to make the money available to you at intervals chosen by you. But how exactly does a mutual fund makes money? I will explain with an example. Suppose AMC X introduces 100 units of a new mutual fund in the market for $10 per unit. The investors buy the 100 units and the company collects $1,000. Now AMC goes and buys assets such as stocks and bonds with this money, and after a month, the value of the assets it bought grew by $500. When we divide the current total value of $1,500 by the number of units, we get the new net price of a unit or the NAV of $15. This means if we sell now, we get a $5 profit per unit. Now let's see what makes mutual funds one of the best investment assets available out there. As a mutual fund investor, the biggest benefit you get is diversification. A mutual fund scheme usually invests in around 50 stocks or more. There is very little probability that all those companies fail at the same time, and this reduces the risk of your investments. The returns from mutual fund investments easily outperform other traditional investment options by a good margin, and that too at a much lower risk. A long-term investment in equity mutual funds in a growing country like India can easily provide an average yearly return of 15 to 20%. Mutual funds are professionally managed by experienced fund managers. They have expertise in researching industry sectors, individual companies, and the overall financial market. They constantly analyze and manage their funds to get us the best return for our investments. Liquidity is how fast we can convert our investment into liquid cash. Most mutual funds can be sold at any time, and the money is available between 1 to 3 working days. The mutual fund industry is a highly regulated one, and these investments are secured from any kind of fraud. Fund houses and schemes are continuously monitored by regulatory bodies, and new rules and regulations are created to safeguard the interest of investors. Investing in mutual funds is much easier than buying or selling other financial securities like stocks or bonds. Most fund houses and investment brokers offer easy to use interfaces for you to invest in mutual funds. There is also a wide variety of fund choices available, and we can choose one based on our individual risk profile and financial goals. But then that is also its main drawback. In the US, there are approximately 7,000 active mutual fund schemes, while in India, the number is around 2,500. These funds are categorized into various types such as equity and debt, with each having its own subcategories. This large number of options can often overwhelm new investors and make it challenging to choose the right fund. Since most of the investment decisions are taken by a fund manager, the investor has no direct control over his or her investments. But for people who don't have the time and patience to analyze the market trends and make the investments, this could also be a good thing. And then the fees. Since your investments are actively managed by others, mutual funds come with fees ranging from as little as 0.01% to 2% based on the type of fund. These fees, known as the expense ratio, cover the cost of marketing, distribution, administrative tasks, and other daily expenses for the asset management company. Understanding the fundamentals is essential, but what really matters is knowing what are the options available and choosing the funds that fit you best. So in the upcoming videos, I will break down the main types of mutual funds and guide you in selecting the best ones based on your investment objectives and risk tolerance. So do subscribe to the channel and enable the notifications. I hope you got some value from this video. Until I see you again, have a wonderful rest of the day and adios.